Hey everyone, welcome back to Corporate Decoder, the place where we dig into the details of big companies so you don't have to. Today, we are looking at a filing so messy, it needed a whole new version just to fix the numbers. It's like baking a cake, realizing you used salt instead of sugar, and then having to remake the whole thing, except this cake is a public company's financial report, and people are relying on it to make important decisions. We are diving into Driveitaway Holdings, a company trying to shake up the car sales industry with its app-based subscription service. They aim to make car ownership accessible, especially for those who might have trouble getting traditional financing. But as we are about to see, their path hasn't been a smooth ride. This is an amendment, basically a do-over, of their quarterly report from June of last year because, well, they got some of the math wrong the first time. So why are we even bothering with this amended report? Because it tells a story about a company struggling with its internal controls, struggling to get its numbers right, and struggling to live up to its promises. Let's get into it. The reason for this whole amended report boils down to some miscalculations. Apparently, the company messed up how they accounted for stock issued as commitment fees, which are basically payments for promises, in conjunction with placing notes payable. It seems they initially recorded the stock at par value, which is like the sticker price instead of fair market value, what people are actually willing to pay for it. This error cascaded into other areas, affecting their stockholders' equity and deferred financing costs, which are costs related to raising money. They also had some incorrect assumptions when calculating derivative liabilities. To put it simply, they were off on valuing some pretty important stuff, and that had a ripple effect through their financial statements. So what did the company do after they noticed those errors? They put in a table showing the June numbers as originally reported, side by side with the corrected, as restated numbers. This lets you see exactly where they went wrong and how much it impacted their overall picture. I know that balance sheets can be dense, so we will only mention a few big numbers. The original report showed deferred financing costs of around $445,000. After the fix, that number dropped to $406,000. Also, the total assets dropped about $40,000 to $686,000. Those changes might not sound like much, but in the world of finance, details matter and affect how investors see the company. The same goes for the statements of operations, which outline the revenues, expenses, and profits of the business. For the 3 months ended in June, there was a derivative loss in derivative value, which caused them to reduce the reported income for $163,000. There was also the fact that they needed to account for amortization of the debt discount, decreasing their previously stated amortization by $43,000. Long story short, the report had a net loss of about $518,000. Now, here's a key takeaway. The company admits that these errors happened because of material weaknesses in their internal controls. That's finance speak for we didn't have a good system in place to make sure our numbers were right. They lacked controls over financial reporting, monitoring activities, and sufficient resources with the right skills. That's a pretty serious admission, and it points to bigger issues within the company's operations. Why all this matters, it's all about survival. To continue as a going concern, the company will need, among other things, additional capital resources. Management's plan to obtain such resources for the company includes sales of equity instruments, traditional financing such as loans, and obtaining capital from management and significant stockholders sufficient to meet its minimum operating expenses. Also, the company said in the report that it follows ASC 820, which is the Fair Value Measurements and Disclosures Guidance for measuring financial instruments, and that it used estimates when making the report. The fact that they needed to restate numbers and that so much of their processes rely on estimates creates an air of uncertainty for stakeholders looking to invest. What kind of obligations is the company committed to? Looking ahead to the near future, the company must pay off about $1.4 million next year in short-term debt, as well as roughly $15,000 in long-term debt. The company sold 750,000 shares in its common stock this year. As of June this year, there was around 113,301,722 common shares. The company uses derivative instruments as a way to try to reduce risk. Because the company's equity environment is tainted, it means that their finances are so risky or out of whack that they are not allowed to do certain complex financial instruments. Finally, it is important to mention that no director or Section 16 officer adopted or terminated any Rule 10b5-1 trading arrangements or non-Rule 10b5-1 trading arrangements. So what is the big picture here? Driveitaway has a compelling vision to change car ownership to make it more accessible, but this vision is clouded by some serious financial and operational challenges. The restatement of their financials highlights major weaknesses in the company's internal controls, indicating that they are struggling to accurately track and manage their own money. Now, looking at these results more broadly, what do they tell us about the business? Direction. Driveitaway is trying to expand its services and get into the electric vehicle market, which could be good, but the restated finances and operating at a loss is a serious sign. Notable risks. Cash is a huge problem for the business. The restated finances will make it harder for the business to secure more cash. Clear conclusion. While the idea is interesting, Driveitaway's messy financials make its future success extremely uncertain. This episode serves as a reminder that even the most innovative ideas need a solid foundation of financial discipline and internal control. Without that, the road to success can quickly turn into a dead end. Thanks for watching. If you enjoyed, please subscribe, like, and comment.